Today, the superpower of our world, the hegemon, the United States of America, is under severe economic pressure. Experts across industries are alarming citizens that the country's markets are in a bubble and will blow very soon, and esteemed investor Jeremy Grantham is no different. In fact, Grantham claims that the US markets are currently in what he deems a super bubble. There are tons of fearmongers on the internet making baseless claims of an economic apocalypse. Therefore, if we are to talk about such a dire probable event, it's crucially important to understand the pedigree of the individual making that claim. Grantham is counted among the legends of the investment world. He is the founder and chief investment strategist at GMO, managing over $118 billion in assets. He has also founded Battery March Financial Management, one of the companies which gave the world the concept of index funds. Not only has he reached the pinnacle of financial success, but in 2011, Bloomberg included his name in their most influential 50, which according to Bloomberg is a list of people who have the ability to move markets or shape ideas and influence government policies. Now, apart from his illustrious career in finance, he is also known for his philanthropy and has received the Carnegie Medal of Philanthropy. If you've never heard of him before, you're probably wondering what makes him so different from the rest of the billionaires and influential folk out there. Well, let me begin by saying that if you think Grantham's statement about a super bubble seems scary, the accuracy with which he's been able to predict chinks in the economic armor is scarier. He is someone who has precisely predicted two major bubbles in the past, the first being the internet bubble of 2000 and the second being the housing bubble in 2007. Recently, he's been highly candid across media channels about his instinct on the macroeconomic predicament of the US, stressing that this time we aren't just in any ordinary bubble, but in fact one that will have effects exponentially more significant than the Great Crash of 1929. But first, a really quick word from this video's sponsor, Masterworks. Now, stagflation, it's a scary word, and what it means is even worse. For those who don't know, stagflation is an economic situation where inflation is high and economic growth slows. With inflation soaring to 8, 9 or even 10%, a global crisis, and top firms predicting stock market returns under 5% until 2035, the threat of stagflation is very real right now. Now, what does this mean for you and me? Well, restructuring portfolios has never been more difficult or more crucial. So where can you turn? Well, you will know that I've been advocating for alternatives for years now, and they've done pretty well for me. And it seems like people are finally catching on. A recent JP Morgan report declared that alternative assets are no longer optional. In light of this new normal, certain platforms have arisen, giving access to the top alternative asset classes. Now, there's one in particular that seems like a complete no-brainer to me, and it's called Masterworks. Now, Masterworks has solidified itself as the platform for investing in contemporary art. They let you access their exclusive investments from names like Banksy, Monet, and other important artists for just a fraction of what billionaires pay to purchase. Now, roughly 2/3 of billionaires allocate between 10 and 30% of their overall portfolio to art, in part to diversify and because it's a natural hedge against inflation. It makes sense, after all. Contemporary art prices outpaced the S&P 500's total return by 164% from 1995 to 2021, and they've exhibited the lowest correlation to equities of nearly any major asset class. Since 2020, Masterworks has sold 3 paintings, with each returning over 30% net IRR to their investors, and their new offerings usually sell out in hours. Here's exactly how they do it. The Masterworks research team analyzes over 60,000 data points to find financially attractive works that they believe will appreciate in value. Then Masterworks acquires paintings ranging from $1 to $30 million, and they securitize them by filing a public offering with the SEC. It is that easy. If you want to get in on it early, all you have to do is go to masterworks.io, create an account, check out what they have and invest in their offerings, and my subscribers get to skip their waitlist at the special link in my bio.
A year ago, you predicted an epic collapse in stock prices, and you told me it would rival the 1929 crash and the dot-com bust of 2000-2001. Were you wrong?
No, I don't think so. I noticed, reviewing it last night, that there was one little element of contradiction. At one stage I said, you can't call these events to within a few months. And at another point I said, history says that when you reach this level of craziness, the market tends to break within a few months rather than a few years. And I think with hindsight, the market started to get distinctly weaker about 10 months after we talked. So that's a few months plus a little bit.
All the same, 2021 was a great year for stocks. If I'm not mistaken, the 7th best in a half century.
And this has been exactly how the great bubbles have broken. The blue chips, the S&P 500, have kept strong right up to the last second, and wave after wave of the stocks that had made the real running peel off and drop. In 1929, the flakes were down for the year before the market broke. They were down 30%. The year before, they'd been up 85. They had crushed the market. The really classic example of this is the Russell 2000, which is stock number 1001 to 3000. They're multi-billion-dollar companies. They're a serious enterprise. In the last year, they are down. They have not made any money at all. The S&P's made 23%. The Russell 2000 is meant to go up about 1.2 times the market. In a bull market like you're saying there was, it should have been up about 30%. It wasn't even up recently. This is a huge divergence of a kind that has never happened other than the super bubbles of 1929 and 2000. 2000, you may remember, the growth stocks peeled off and were down 50%. The S&P was flat, which meant the remaining 70% had risen 20%. This is an enormous divergence, and it happens on the upside for the blue chips. So this is it's almost eerily classic.
It's a pattern.
It's a pattern. It's a very rare pattern. And we have been checking off this list all year. When I sat down a year ago, we had seen the accelerating phase that you need in a bubble. That had taken place last year with the NASDAQ up over 100 from the low, but also up 58% from December of 2019. So even granted that COVID decline, it was a hell of a year. It was a year of acceleration. And the NASDAQ has started to weaken relative to the blue chips. The Russell has started to weaken much more so even than NASDAQ.
Now let's begin by understanding Grantham's definition of a super bubble. He claims that, unlike situations in the past, the US market isn't under pressure for any one particular reason. His understanding is that the country is not in one, not two, but 3.5 bubbles. The first one, no doubt, is the equity market. The second one is the bond market. The third one is the housing market. And finally, the last half is the commodities market. Now, a bubble is typically formed when valuations differ significantly from their average levels, which is mathematically calculated by the standard deviation. Grantham's investment strategy relies on a similar method famously referred to as reversion to the mean, which essentially means that in the long term, all asset prices tend to revert to historical mean levels from their highs and their lows. In simple words, the standard deviation is the average difference from the average. Therefore, a significant difference from that average indicates that we're in a bubble. Now, the first significant bubble, according to Grantham, is the US equity market. To explain the equity bubble, let's look at the 100-year Shiller price-to-earnings ratio chart of the S&P 500, which measures how much you and I are willing to pay in dollars for every dollar of profit earned on the S&P 500. As I mentioned, we need to see how far the numbers are from the average. In the chart, the red dotted line in the yellow zone refers to the mean. The very first time the US experienced a major market crash was during the 1929 bubble in the light pink zone. This was then followed by a reversion in the coming decades, and the next crash was in the year 2000 during the dot-com bubble, which is the dark pink zone, which was correctly called out by Grantham at the time. Another instance where Grantham was spot on about spotting bubbles through standard deviation was the colossal crash of 1989 in Japan, which goes to say that his methods of identification of a bubble are deep-rooted in reality. Now, of course, we're in 2022, which is in the dark pink zone, far away from the mean and the average valuation we've seen historically, which according to Grantham means it's code red. We live in a hyper-connected world where communication has never been more efficient. We are bombarded with information day in and day out, which proves advantageous and disadvantageous in equal parts. A small data leak travels across the earth within no time and causes a butterfly effect that affects us all. Grantham attributes the equity bubble to another factor, euphoria or craziness. He says that today, people are pouring tons of money into the markets purely based on hype, which drives valuations into a frenzy. One tweet by some random person and a stock can either soar or it can dump. We've seen this characteristic play out so many times with stocks like AMC, GME and Tesla, where in a short period the asset values went 50 or 100x for absolutely no fundamental reason and, frankly speaking, purely on hype. We are cursed with what Gen Zs call FOMO, or fear of missing out. Grantham is certain that impulsive buy-in will lead the world into chaos. Now, Grantham's second bubble is the US housing market. He uses the analogy from Japan's 1989 crash, where he says that whatever you do, don't have gloriously overpriced housing markets at the same time as you have a stock market bubble. Today, the median price of US homes cost nearly $400,000, a whopping 20% increase from 12 months ago, and there is no sign of it stopping. A majority of these properties are being sold above their correct market value, mostly entirely in cash, and the situation is an absolute pandemonium. The biggest contributor to this phenomenon is obviously the monetary control room of America, the Federal Reserve. In January 2021, the 30-year fixed-rate mortgage rate dropped to a low of 2.7% to incentivize retail investors to buy homes at throwaway rates. This is rock bottom, the lowest it's been since 1970. The catch, though, is that the government started another program called the Primary Dealer Credit Facility, which has been revived since the financial crisis, with the help of which major hedge funds, banks and the likes can actually acquire extremely dirt cheap credit anywhere for rates as low as 0.25%. This basically means that individuals and gigantic institutions have access to unheard of levels of capital at near zero cost. What this means is that banks are competing with each other with cash that isn't theirs and they pay hardly any interest on to drive up inflation of home prices. Now, although Grantham isn't as worried about the housing bubble as he is about the equity market, that is because real estate as an asset has characteristics of equity and debt. If you buy a house and choose to rent it out, where you receive rent periodically and end up selling the house in the future, the rents you receive behave like the fixed promise payments of a bond, and the sale of the house behaves like the equity. In the US, since mortgage rates are more underpriced than your house is overpriced, Grantham states that if you buy a house and choose to keep it for about 30 years and you're prepared to rent it out, it's highly likely that you'll be okay. Grantham's third bubble, though, is in the US bond market. Just like mortgage rates, bond yields are at historic lows, although they have been increasing rapidly in recent times. He mentions that since rates are so low, the US has the highest priced government bonds compared to most countries in the world. Due to this very reason, Grantham suggests that we don't invest in bonds that have a very high duration. If people are adamant that they should buy bonds, then they should buy shorter duration bonds or just have cash to hedge equity positions. Now, Grantham's last half bubble is in the commodity market. Before we head into this, though, it's worth pointing out that this isn't a bubble that is as worrisome as the other three, according to Grantham. Now, that's simply because of the fact that most retail investors do not have exposure to the commodities market, as it's primarily an institutional play. Nonetheless, what is worrying, in fact, is what he refers to as the income effect. If the price of oil goes up to $120, it also subsequently affects the price of grain and metal. The repercussions of that are the common man's cash in hand or disposable income reduces significantly because of it. That means that even though retail investors aren't directly involved with this market, the indirect effects are stealthy and intense, to say the least. So the natural question arises, how is it possible that a bubble is bloating in almost every other asset class in the US all at once? Now, it shouldn't and it doesn't make any sense that people are able to keep pumping money into the market to the point that everything begins to boil. These market dynamics may seem absolutely crazy, but there is a reason for this madness: excess liquidity. In the past decade, due to umpteen different reasons, the Federal Reserve has maintained the interest rate at record lows, almost near zero, due to which access to capital has never been easier and definitely never been cheaper. When a country enters a severe economic recession, one of the remedies the central bank has the power to deliver is something known as quantitative easing. The term may seem intimidating, but it's actually quite a simple concept. QE is an action that central banks take to inject stimulus into the economy when times are tough. Central banks start buying back existing government bonds from the economy in order to enhance the money supply. What most people don't understand is that all government bodies are obviously bound by budgets, but that doesn't seem to be the case with the Federal Reserve. In order to buy back these bonds, the Fed has the authority to literally print money, and in quantities as large as they please. Therefore, in the past couple of years, when markets took a hit during the pandemic, the Fed went overboard with printing obnoxious amounts of money. At this point in time, about half of all the dollars in circulation in the world today have been artificially printed over the course of the last 2 years. But of course, there are repercussions of such an aggressive expansionary monetary policy. The price we pay for that is inflation. Now, the world is well aware that the US is struggling to fight inflation, which has reached an all-time high of 8.5%. Now, I mean it when I say America needs a miracle to fight this, because at this point, one wrong move by the Fed and the markets and the economy will come crumbling down. Financial analysts and economists alike are worried that due to the low interest rates that the country is already suffering from a liquidity trap. This is a situation where investors like you and I are indifferent between holding hard cash and actually buying bonds or depositing money in the banks because there are negligible returns. Eventually what happens is the economy reaches a state where, despite there being so much money in circulation, people aren't willing to spend, which in turn doesn't increase the real incomes of its citizens. Now, before we sign off for the day, in a previous video I've explained Charlie Munger's view on returns and his concept of the lost decade, and let me tell you, Grantham's views aren't different either. Grantham believes that in the next 10 years there's little to nothing to gain in the US equity market because he thinks that a correction is due. According to his statements, investments in the US equity markets will either stagnate or decrease in value. But if someone still wishes to go ahead and invest anyway, his advice is to seek value stocks as opposed to growth stocks. He goes on to say that value is pretty darn cheap as opposed to growth these days. Grantham's second piece of advice is to explore emerging markets. There's certainly a lot of doubt around the Chinese markets, but if you compare its forward price to earnings ratio to the US, you can conclude that it's way undervalued. There's also no reason to only look at China. There are so many other emerging countries like India and South Korea that have tons of upside in the years to come. Grantham very candidly shares his secret sauce for the next 10 years, where he says that identifying value stocks in emerging markets will be a portfolio game changer. Now, this was the body and soul of Jeremy Grantham's super bubble, but very recently we saw a major twist. In a recent interview with Think Advisor, the very bearish and skeptical Jeremy Grantham went on record to say that he's not entirely sure that this super bubble will pop because of the tensions in Russia. He blatantly says that Putin is borderline psychotic and fears that World War III may just become our new reality. The war will, in Grantham's opinion, elevate people's systemic risk as the likelihood of nuclear apocalypse is increasing. Grantham says, and I quote, "There's never been a war thrown in the middle of a major bubble like this, so I reserve the right to take a while longer to think it through and work out the implications. We were certainly in the vampire phase, but I'm humble enough to say that when a war of this magnitude occurs, with ramifications that could extend beyond that, all bets are off." So one thing is certain, we have stalwarts like Munger and Grantham tag teaming on the same bearish philosophies for the coming few years, both predicting that the bubble is extremely real and investors need to reinvent their strategies and be prepared. And of course, I completely agree with Grantham's point of view that nobody can reliably and accurately predict when a bubble will actually burst. Now, if you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio, and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that can help you protect your portfolio against inflation through fractional shares of art from world-famous artists like Banksy. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets on the brink. It's completely free to sign up, so make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get over 7% interest on stablecoins to protect your hard-earned cash from being eaten away by inflation. Thanks for watching, stay stoic, until next time.